Allegiant Air has been on an absolute tear lately. But, with any stock that's flying this high, you have to ask, can it actually keep this altitude, or is it getting a little too close to the sun? Today, we're going to dive into an analysis from Zacks Equity Research to break down all the pros and cons and figure out if Allegiant is a buy, a sell, or maybe just a hold.
So, get this. In just the last 6 months, Allegiant stock has shot up by an incredible 52%. Now, that isn't just good. That's the kind of performance that leaves its competition, major players like Southwest and Ryanair, completely in the dust. A run-up like that always makes you wonder.
Is this surge for real, or is it time for investors to grab their profits before things get bumpy? That is the big question we're tackling today. We're going to unpack everything that's pushing the stock up and then look at the risks that could pull it right back down to earth.
All right, so first up, let's look at all the good stuff, the tailwinds. What are the powerful forces that are actually fueling this climb for Allegiant? The argument for buying in, well, it starts with some seriously strong fundamentals.
According to Zacks, the positive case for Allegiant really stands on a few key pillars. First off, the market itself is just booming with passenger demand. Then you've got the company's own health. They're upgrading their fleet, and they're in a rock-solid financial spot. And for investors, they're making smart, shareholder-friendly moves, and maybe most importantly, the stock might still be a bargain.
The main engine driving all this growth? It's that huge post-pandemic demand for travel. People are just eager to fly, and you can see it right in the numbers. Passenger revenues, which, by the way, make up almost 89% of their business, jumped 3.9% year over year in the first 9 months of 2023. That's a super healthy sign.
And this isn't just looking in the rearview mirror either. The company's pretty confident the good times are going to keep rolling. For the fourth quarter, they're projecting about a 10% increase in capacity. That's in available seat miles, which is just a fancy way of saying their total space for passengers. And they're expecting a really healthy operating margin, somewhere between 10 and 12%. So the big question is always, how ready are they for a rainy day? The answer seems to be very ready. This number, nearly $1 billion, is how much cash they had on hand at the end of the third quarter. That is more than 3 times their current debt of about $270 million. It shows they're in a really stable financial position.
Now let's talk about what might be the most compelling argument for the bulls, the stock's valuation. Before we look at the numbers, let's just quickly break down what we're looking at. The price-to-book ratio, or P/B, basically compares the stock's price to its book value. You can think of book value as the company's net worth if you sold everything off. A low number here could mean you're getting a real bargain.
And here's where it gets really interesting. Look at this. Allegiant's PB ratio is just 1.53. The average for its industry, it's more than double that, sitting at 3.10. What this suggests is that even after that huge 52% jump, the stock might still be seriously undervalued compared to its peers.
Okay, so you've got strong demand, solid finances, and a great valuation. It sounds like clear skies ahead, right? A definite buy? Well, not so fast. As any pilot will tell you, you always have to check the forecast for storms on the horizon.
So now we have to flip the coin and look at the other side. Let's talk about the headwinds. What are the potential risks that could cause this high-flying stock to suddenly lose altitude?
The Zacks analysis really points to 3 big areas of concern. First, costs are going up, especially labor costs. Second, there are problems outside their control with getting new planes delivered. And finally, the big picture economy could throw a major wrench in the works.
And this table really shows you the pressure points. I mean, look, even with fuel costs going down by almost 10% in 2023, their total operating expenses still shot up over 20%. And the main culprit? A massive 19.2% jump in labor costs. This is an industry-wide thing, with new union contracts costing a lot more, and it's putting a real drag on profits.
Here's another major challenge, and this one is completely out of Allegiant's hands. All the production and quality control problems over at Boeing mean that new airplanes just aren't showing up on time. This is a double whammy, because it not only caps their ability to grow, but it also means they have to spend more on maintenance for older planes they can't retire yet.
And of course, there's the elephant in the room, the overall economy. That strong travel demand that's been so good for Allegiant, well, it's directly tied to how confident people are feeling about their wallets. If the economy slows down and people start to tighten their belts, you can bet that vacation spending is one of the first things to get cut.
So you've got this classic tug of war, a company with booming demand, but also with costs that are really starting to rise. So how do the analysts balance all of this to come up with a final call?
And here it is, the whole debate in a nutshell. You have these powerful tailwinds, strong demand and attractive valuation, solid financials, and they're going head-to-head with the headwinds of high labor costs, delivery delays, and economic risks. This is the central conflict for anyone looking at Allegiant right now.
So what's the final verdict from Zacks? Well, it's actually pretty nuanced. If you're thinking about buying the stock, they suggest maybe pumping the brakes and waiting for a better entry point. But if you already own shares, their advice is to hold on and just stay the course.
And all that advice gets summed up in their official rating, a Zacks rank number 3. And that translates simply to hold. It's not a screaming buy, and it's definitely not a sell. It's this cautious, neutral stance that perfectly reflects the balance between the huge opportunities and those very real risks.
So in the end, Allegiant is really a classic investor's dilemma. You've got a company that's doing really well, but there are definitely some storm clouds gathering out there on the horizon. The analysis points toward caution, which leaves every single investor with the same big question. Do you bet on the clear skies ahead, or do you wait on the ground for that storm to pass?